Hey everyone, if you're a US business doing any kind of work with Japan, you are going to want to see this. We're about to unpack a really nasty surprise, a 20% tax that could be taking a huge bite out of your revenue. But don't worry, because we're also going to show you how one simple form can make that entire charge disappear.
Okay, so let's set the scene. You did it. You just landed a huge contract with a Japanese company. Maybe you're licensing your software, selling the rights to a film, or even leasing some heavy-duty equipment. The deal is done, and you're just waiting for that first big payment to roll in.
But then, the money hits your account, and your jaw just hits the floor. It's short, by more than 20%. A huge chunk of your money is just gone. You're checking the math, you're calling the bank, but nope, there's no mistake. So what in the world just happened?
Well, what you just ran into is Japan's default withholding tax. It's not a mistake, it's not an error, it's actually a standard procedure where your Japanese customer is required by law to hold back that money and send it straight to their government before they even pay you.
To figure out why this happens, we have to look at Japan's own internal tax rules, what's known as its domestic law. Think of this as the standard default playbook for how they tax any money being made inside their country.
And right here, this is where the whole problem starts. You see, under Japanese domestic law, the definition of a royalty is just incredibly broad. Sure, it covers the stuff you'd expect, like patents and copyrights. But, and this is the crazy part, it also includes payments for just leasing physical things like machinery and equipment.
And because they define it so broadly, the law says they have to snatch 20.42% from your gross payment. That's the important part. Gross. It means you don't get to deduct any of your business expenses. They take it right off the top, no questions asked.
But hold on, don't panic. There's actually a hero in this story. It's a special agreement called the US-Japan Double Tax Agreement. The best way to think about it is like a special rule book that, for US residents, can totally override Japan's regular laws.
So you've got this conflict, right? On one side, there's Japan's default law, ready to slap you with that 20.42% tax. But on the other side, you've got the US-Japan tax treaty, which was literally designed to prevent this exact thing from happening. It's your way out. And this is the most important rule of the game. When the rules in the treaty clash with Japan's domestic rules, the treaty wins. Every single time. It has the final say, period.
Okay, so how does this actually work? Well, the entire solution, the whole magic trick, it all comes down to one simple but really powerful difference. The treaty defines the word royalty completely differently than Japanese domestic law does.
Let's use a pretty dramatic example here. Let's say you lease $1 million worth of machinery to a company in Japan. Under their domestic law, that payment is, bizarrely, called a royalty. And just like that, poof, they withhold over $204,000.
But now, look at the treaty's definition. It's so much more logical. It says royalties are payments for things like copyrights and patents, intellectual property. And here's the kicker. It specifically excludes payments for using industrial, commercial, or scientific equipment.
And this is where you see the magic happen. Because that equipment lease is no longer a royalty under the treaty rules, that Japanese withholding tax plummets from over 20% all the way down to zero. That's $204,000 right back in your pocket.
And get this, it isn't just for leasing equipment. The treaty wipes out the Japanese withholding tax for almost every kind of intellectual property you can think of. Patents, software copyrights, trademarks, trade secrets. For a US resident, the treaty rate is 0%.
Now, this all sounds fantastic, right? But there's a little catch. These benefits aren't automatic. You don't get that 0% rate just because you're American. You actually have to formally apply for it.
Luckily, the process is pretty straightforward. First, you gotta prove you're a US resident, which you can usually do with a form from the IRS. Second, you fill out a specific Japanese document. It's called Form 3, and you give that to your client in Japan. And third, you just have to meet a couple of key conditions in the treaty itself.
So the two main conditions are: one, you have to be the beneficial owner of the money, meaning it's actually for you and you're not just a middleman passing it on to someone else. And two, you have to meet something called the limitation on benefits rule. It's basically there to stop companies from other countries setting up empty shell companies in the US just to cheat the system and get these tax breaks.
So, if there's one thing to take away from all this, it's this. When you're dealing with Japan, definitions are everything. How your income gets labeled, whether it's a royalty, a lease payment, or something else,
is the thing that decides whether you pay 20% or 0.
And hey, don't just take my word for it. This quote from the treaty itself says it all. It clearly states that the power to tax these royalty payments belongs only to the country where the owner lives. In our case, that's the US. Japan basically agrees to give up its right to tax that money at the source.
And that really brings us to a final, very important question for you. Go take a look at your own contracts. Are you leasing equipment or licensing IP to a company in Japan? Because if you are, and you haven't been claiming these treaty benefits, you could literally be leaving a fifth of your revenue on the table. It might just be time to take a closer look.